And now we are joined by Mr. Bhavik Mehta, Deputy Head of Research at Century Financial. Good morning, Mr. Mehta. Happy to have you back.
Good morning to all the viewers.
What's your opinion? Are we at the end or at the peak of this tightening cycle from the central banks?
If we talk about this week's FOMC meeting, we've already discounted a 75 basis point rate hike. The rally in the last month that you've seen in US index is primarily on account of markets expecting that the December could see a Fed fund peaking at 50 basis point increase. But literally to be saying, most of the Wall Street analysts have their base case scenario on an assumption that the Fed target range, the neutral range, will not exceed 4.75 and the 4.75 to 5% zone. But it is too early to say that we are seeing the peak in the Fed funds rate, because what is happening is, if you look at the latest labor cost data, if you look at the latest PCE data, that is the inflation gauge that the Fed tracks, there are signs that inflation is going to stay sticky. And what started as a goods inflation has now fully percolated to a labor based, a wage based, and a service based inflation. So, any more acceleration in this core PCE in this indices, as well as the labor cost employment indices, the Fed will definitely want to go in more hawkish. So, markets would again try to reprice the target range to a more higher range. So this is where things can get very much bad for the markets.
Mr. Mehta, but no one is saying that the inflation reached its peak or we ended the battle against inflation. But after all the hikes that we saw consequently, maybe the Fed should take a pause, a break to assess, to analyze, and then to take the other step, or to leave the step have the impact on the markets or the economies.
True. I agree with you completely that the Fed should take a pause and maybe hike by a lesser amount of, let's say, 50 basis point or even 25 basis point. But then again, what we are expecting is something that the markets want, the investors want. Recent comments from Fed Chair Powell, they are not so much supportive of a dovish tone. Now, if you look at the overall comment from the FOMC members over the last 2 weeks, there is a high probability of the Fed sealing a 50 basis point rate hike in December. But I would say it's still a good 40 to 45 days after this week's meeting happens. So any kind of data might come in. The Fed will not necessarily try to entertain the markets, but to be on a safer side, we could see a softer 50 basis point rate hike in December.
Mr. Mehta, you said that we could see 50 base points tomorrow?
No, I'm talking about the December meeting.
Mr. Mehta, so in December we might see 50 base points, and this is the consensus among analysts, while Goldman Sachs as well said that the peak would be 5%, not 4.75 as final rate. Do you think that the markets now are being cautious, more cautious, instead of having this hysteria? Are we at a point of realism, for example, in the market?
Too early to say that the Fed is going to pivot and the entire thing is going to be again restructured, revamped. All eyes will be actually on what the outcome of tomorrow's FOMC meeting will be, because currently, as you've said rightly, that markets are trying to be safe. They're trying to be optimistic in assuming that Powell is going to struck a little bit of amount of dovish tone, and maybe reassure markets that the amount of drawdown that we've seen in the risk markets, they might come to the rescue and signal a softer 50 basis point. So it would be really worthwhile to, it would be really interesting to note how tomorrow's press conference plays out.
Mr. Mehta, exactly. So nowadays, maybe the tone is more important than the numbers, but at the same time, we see that the stock markets in particular are registering some optimism. yesterday some decreases, but this does not mean, that the trend would be bearish only, despite the quarterly disappointing results for big companies. What are your expectations now in light of these results and to be announced this week with the Fed?
We could broadly look at two major scenarios. The first scenario where the Fed Chair Powell readily accepts that the rate hikes so far have been satisfying for the Fed, and they might see inflation peaking out by the mid or the end of the next year, and they might outrightly signal a 50 basis point rate hike in December. If such a scenario happens, we could see the last month's rally further consolidating toward upside. On the downside, if there is a scenario where Powell again tries to be more hawkish and leaves all the options open on the table, including a 75 basis point rate hike in December, then you could see a little bit amount of downside correction for the markets.
Mr. Mehta, a bit of correction, like what? 3,700, for example, as we saw on S&P, for example.
Yes. So
3,800, sorry.
yeah. So we are talking about the at least a 50% retracement of the entire October rally. So take an example of SPX index. The October gains were roughly in the range of 9 to 10%. We could be heading back towards the 3550 3600 base zone for SPX.
Thank you very much, Mr. Bhavik Mehta. Joined us from
Thank
Dubai,
you.
and until next time.